Welcome to the third quarter Wespath webinar. My name is Joe Halwax. I'm the Managing Director of Wespath's Institutional Investments team. I'm coming to you here from our offices in Glenview, Illinois. I eagerly await the webinar where I can start by commenting on how quiet and boring the markets were. While I'm thrilled to no longer have to show the COVID infection slide that we've used for 2 years, we're now experiencing new uncharted waters. The residual long-term effects from the economic measures taken during the pandemic created generational high inflation, which has forced the Federal Reserve to increase interest rates. Coupled with similar issues across international economies, plus the fallout from the ongoing Russia-Ukraine conflict, we've seen global market volatility soar. We started the quarter with a market rally that fizzled quickly following the strong hawkish comments from the Fed in August. In September, the markets were further rattled by elevated inflation numbers and an escalation of the Russia-Ukraine conflict. While the economy may technically be in a recession, this is a unique time. We have slow economic growth, but continue to maintain a tight labor market with near record low unemployment. We also have a Fed that's raising rates into an already slowing economy because the threat of inflation is greater than the threat of a slower economic growth. Today you will hear a brief organizational update. I'll update you on the markets. My colleague Karen Manczko will review the performance of our funds. Dave Zellner will share an economic update. And finally, Jake Barnett will close us out with an update on the work of our sustainable investments. The busy quarter provided many opportunities for thought leadership. Most recently, I provided an overview on the third quarter, reviewing many of the factors which we will discuss in more detail today. My colleague Evan recently wrote about how expectations out of the Fed have significantly shifted from 1 year ago. He also wrote about the opportunity for investors to put their cash to work in this higher rate environment. Finally, Mark Warren, the manager of public equities, wrote about our investment due diligence process. All of these articles are available on our website. Welcome to the market update for the third quarter. During the second quarter update, the markets had underperformed, but investors also saw glimmers of hope that inflation had peaked and the Fed might pivot to a more dovish stance. We started the third quarter with a relief rally in July, but ended with losses across asset classes. In August at the Fed's Jackson Hole conference, Chair Jerome Powell's messaging was hawkish on squashing inflation and remaining tighter for longer. A few weeks later, the Consumer Price Index report came in hotter than expected, and markets further struggled. You can see the losses in both equities and fixed income on this slide. Let's start with international equities. The losses were much sharper in the third quarter, taking the year-to-date returns below those of U.S. indexes. The MSCI EAFE index was down over 9% quarter to date, with the MSCI Emerging Markets Index falling by almost 11% on the quarter. One of the challenges for international markets is the strength of the U.S. dollar, up over 16% on the year, which Dave Zellner and I will discuss shortly. But what else can explain the relative weakness in international markets? While the U.S. economy feels weak to those of us living here, in developed markets outside of the U.S., growth is even slower and inflation is higher. Europe is experiencing an energy crisis due to dependency on Russian oil supplies, and this has largely been shut off since February. There's a lot of uncertainty about how the European economy will navigate this winter. This includes the possible shutdowns of manufacturing. In the UK, the recently elected Prime Minister began her term with a tax cut that was wildly unpopular with markets, and it forced the Bank of England to intervene on their cratering bond market. China is still maintaining a strict zero-COVID policy, and its real estate market is looking increasingly vulnerable to a shock. In short, international markets are facing the same inflationary headwinds as the U.S., but also dealing with idiosyncratic events that weighed on asset prices this quarter. All said, there are actually some bright spots. International equities are cheap based on traditional valuation metrics, which our Chief Investment Officer Dave Zellner will discuss shortly. Additionally, the energy crisis is rapidly being addressed with new supply chain development. And finally, the dollar is unlikely to continue its meteoric rise. For long-term investors, we remain steadfast in our belief that international markets offer good value. Turning to the US, this was the third consecutive quarter for losses in the S&P 500. This is the longest correction since 2009 and takes the index back to levels last seen in November of 2020. This is when we were still working from home full-time and before vaccines. Despite an 18% rally in the first 6 weeks of the third quarter, the S&P 500 entered the quarter down 5% and at new lows for the year. The U.S. mid-cap and small-cap indexes ended down 2.6% and 2.2% respectively, outperforming large caps. This is a chart of the S&P 500, where you can see the all-time high on January 3 of this year. In the box at the top of the chart, you can compare several metrics to different points in time. Looking at February 19, 2020, or at the start of the pandemic, the index was at 3386, with a price to earnings of 19.2, and the 10-year yield was 1.6%. Then you can see on January 3 of this year, 2022, the index was 41% higher, with the same 10-year yield, but a PE of 21.4. We closed the third quarter with an index that's sharply lower than the start of the year, now at 3586, a sharply higher 10-year yield, but also a much cheaper valuation at just 15.1 times earnings. While the 3.6% yield on the 10-year is much more attractive than what we've seen in recent years, U.S. equities are also much cheaper on a valuation basis than at the start of the year. Dave and I will discuss equity valuation shortly. Let's look at fixed income. And we'll start with the Fed, which has been very aggressive, with 3 consecutive 75 basis point rate hikes and an additional 75 basis point rate hike likely in early November. The blue line at the bottom of the chart is where yields were at the beginning of 2022. The green line at the top of the chart shows rates at the end of September. My colleague Evan Witkowski pointed out in his recent blog that the difference between interest rate expectations today versus a year ago is staggering. You can see just how much they changed on this dot plot slide. Each dot represents one Federal Open Market Committee participant's projection for interest rate expectations. In September of 2021, the median Fed rate projection for September of 2022 was 0.25%, with the median expectation of 1% at the year's end. The median estimate for 2022 year-end Fed's rate now is 4.4%, with an expectation that rates will peak at 4.6% in 2023. Let me put it this way. Short-term interest rates will end 2022 over 3% higher than was forecast just 1 year ago. It is unsurprising that markets in both equities and fixed income have experienced such drastic declines. The next chart is a great visual representation of how uniquely challenged bond returns have been in 2022. Since 1976, the largest intra-year drawdown was 9%. The worst annual return was negative 3%. Currently, we're sitting at negative 15%. In the US, the 10-year yield rose the last 9 straight weeks of the third quarter. This is the longest period of consecutive week increases since 1994. The longest streak ever was in the inflationary period of 1984 at 12 weeks. The sharply higher yield curve explains the unprecedented losses in the bond market, the worst we've seen in history. But there is a silver lining. Bonds are cheap by all measures. This slide, created by our friends at JP Morgan, shows just how inexpensive bonds are relative to the last 10 years, using a metric called yield to worst. Yield to worst is the worst return received on a callable bond, assuming no defaults. So looking at multiple fixed income sectors, the gray bar represents the 10-year range of the yield to worst. And the purple bar is the median yield over the last 10 years. The blue diamond is where we stand at the end of the third quarter. In other terms, the yield offered by bonds is near the very highest seen in the last 10 years for most sectors, meaning bonds look very attractive compared to the beginning of the year after the carnage of the last 9 months. We're frequently asked about bonds in a balanced portfolio given the very low yields of recent years. Looking at the next several quarters, bonds will again offer yield and income. We also expect that they will be much less correlated to equities once we see more normalized levels of inflation. We know that 2022 is a bear market for equities. How does that compare to historical bear markets and the Fed's response? Let's start with the last 8 bear markets on this slide. In the most recent bear markets, the Fed was able to cut interest rates to bolster economic growth. However, this time the Fed is forced to aggressively increase interest rates in order to temper inflation. I would call this uncharted territory. What we've seen in terms of market moves is also unprecedented. Here's a table showing the last 8 times the S&P closed the year with a loss. The third column shows the return for U.S. bonds in that same year. What this table shows is that historically, bonds have offered positive returns in times when stocks were negative. The exception is 2018 when bonds were flat. But typically, bonds have offered diversification in a balanced portfolio. The bottom line shows the current year through the end of September. With data back 100 years, this is the first time we have seen both bonds and stocks down double digits. Lastly, let's look at a chart of various asset class returns since 2007. The white box represents a balanced portfolio, which is labeled asset allocation, and is similar to the portfolios of the majority of our clients. What this table shows is that for the last 15 years, a balanced portfolio has done what it's supposed to do: provide positive returns, but with lower volatility than had you had just a concentrated portfolio in stocks, bonds, real estate, or commodities. The balanced fund is never at the top of the chart, nor at the bottom. Even year to date, with the negative 19% returns, they're not pretty on an absolute basis. The balanced portfolio is still above the median of all asset classes. This helps show why many of our long-term investors use globally diversified portfolios to fund their mission. This concludes my remarks. Thanks for joining today. I'm joined now by a familiar face, my colleague Karen Manczko. Karen, it's great to have you back here for this update. Tell us how Wespath for Funds formed in the third quarter.
Thanks, Joe, and hello, everyone. It's great to be here with you all. Since the last quarterly update, the markets have been somewhat of a roller coaster. Stocks ended strong in July and continued the rally into the first half of August. This was due to the investor belief that the Fed would pivot from its aggressive stance in raising interest rates. Unfortunately, that sentiment was short-lived. In late August, the Federal Chairman Jerome Powell made hawkish comments at the Fed meeting in Jackson Hole, indicating 75 basis point rate hike, which the Fed followed through and officially raised rates in September. This adversely affected the markets, and they declined the rest of August and September. You can see on the slide that both equities and fixed income ended the third quarter down. You can also see that the U.S. equity, fixed income, and the inflation protection composites outperformed their respective benchmarks, which led to the multiple asset composite outperforming for the quarter. I'm going to spend some more time talking about the individual fund performance contributors and detractors shortly.
Before we move on, Karen, can you talk about the year-to-date performance?
Of course, it's been a challenging year for equities and also bonds. As a reminder, what's been driving the market performance has been the culmination of many domestic and international factors. Global central banks aggressively tightening, inflation rising to its highest levels in over 40 years, the Fed rate hikes continuing to create losses for bonds and concurrently dampening equity markets, the ongoing conflict between Russia and Ukraine, and the fear that a recession is on the horizon. The equity funds are down over 24 and 31% year to date. What is impacting the international markets is the strength in the US dollar, which is up over 16% year to date. International markets are also experiencing weakness in growth and high inflation, much like the US. Both the US and international equity composites have been impacted by our external asset manager stock selection. The stock that these managers held for many years have been out of favor in this market environment. Joe, I believe you shared with me recently that 80% of active managers have been out of favor this year.
That's right, Karen. S&P publishes data showing active versus passive managers. For the U.S., managers underperformed about 80% in the first half of the year, yet better in the second half of the year, similar to what we've seen in our funds.
The international equity composite is roughly 85% actively managed, and the U.S. equity composite is approximately 50% actively managed. This said, active management has benefited our fixed income strategies. The fixed income composite is 100% actively managed, with over 40% of the strategy managed by PIMCO. You can see in the chart that the fixed income composite outperformed its benchmark year to date, despite being down on an absolute basis. The reason for the outperformance has been the fund's allocation to our internally managed positive social purpose lending program and commercial mortgage-backed securities. Also, the overweight allocation to high-yield bonds and issue selection by our Core Plus manager, PIMCO. You can see on the chart that the inflation protection composite is down roughly 8% year to date, but is outperforming its benchmark by over 5 percentage points. The composite's diversifying strategies of floating rate senior secured loans and commodities have benefited this fund on a relative basis. Despite the two bond funds outperforming their benchmarks year to date, the underperformance by our two equity funds has led to the multiple assets composite underperformance year to date.
So Karen, I noticed that you included the short-term investment fund listed on the slide. Any comments you want to add before we move on?
You're right, Joe. The one fund I will highlight that we typically do not is our short-term investment fund. This fund's goal is to preserve capital while earning current income generally greater than that of a typical money market fund. The fund's primary holdings are short-term fixed income instruments, including U.S. government, agency of corporate bonds, securitized paper, commercial paper, certificates of deposit, and other similar like investments. My colleague Evan just wrote a blog that talks more about this fund and how it's positioned to better capitalize on this interest rate environment when that's compared to typical CDs and money market funds. You can see that for the quarter, this fund was up roughly 0.5%. One thing I do want to mention about this fund is that it is best for near-term investment needs, such as near-term obligations, a project, or operating expenses. For an endowment that exists in perpetuity, the best option is to continue to have a diversified portfolio of stocks and bonds that will provide a more competitive rate of return in the long run.
So can you show us how the multiple asset fund fared relative to its benchmark? But how does this fund look relative to other balanced funds?
Yeah, this next chart showcases the multiple asset fund composite versus a universe of balanced funds. This slide measures how our balanced composite performed relative to other balanced portfolios and the funds that are currently in the market. And we're using a universe that is compiled and maintained by Investment Metrics, which is a well-known reporting provider in the investment industry. Looking at the chart, you can see that the multiple asset composite has performed below the median for the 1-year time horizon, but outperformed the median in the 3, 5, and 10-year. For instance, in the 10-year time horizon, the composite outperformed over 58% of other balanced funds in this comparison.
So Karen, moving on, can you tell us about the individual fund contributors and detractors for third quarter performance?
Yes, starting with the multiple asset composite, which is highlighted this on the performance slide earlier, but the primary detractor to the fund's third quarter performance was the underperformance by our international equity fund, which I'll specifically highlight here in a moment.
So you mentioned earlier that the market started the quarter with equity markets positive July and part of August before taking a turn after the Fed's latest rate hike. So how did this impact the performance of our funds?
That's correct. We've seen some major market movements so far this year, which has had a negative impact on both equity and the fixed income markets. So starting with our U.S. equity fund, this fund outperformed its benchmark by 88 basis points for the quarter. The fund's dedicated allocation to private equity and private real estate contributed. As a reminder, these asset classes are priced on a 3-month delay. The fund's overweight allocation to small and mid-cap growth stocks also contributed.
So Karen, you mentioned during your comments that the International Equity Fund was the only fund that underperformed for the quarter. Can you explain why?
Yeah, as I mentioned earlier, the International Equity Fund is 85% actively managed, and our active managers' stocks have been out of favor in this current environment. As you can see listed on the slide, the growth-oriented active manager stock selection in China and e-commerce has had a negative impact on the fund's performance. Some of the stocks that detracted were Shopify, which you recall did really well in prior years, including 2020. Also stocks Snap and Okta also detracted. Also, the fund's allocation to international private equity was a detractor to the fund performance.
All right, so moving on to fixed income funds performance. The equity market's not the only market that's seen volatility. So is the bond market. This is one of the worst bond markets in history, with bonds displaying double-digit equity-like losses.
Yes, the bond market has traditionally been seen as a safe haven for investors when the stock market is volatile. But this asset class has not been able to hide from the volatility we've experienced. The main driver of the bond market performance has been the ongoing inflation concerns and the Fed's goal of trying to control inflation by increasing interest rates. So despite the negative absolute returns by our fixed income fund, it outperformed its benchmark by 52 basis points gross of fees. There are a number of contributors that are listed on the left side of the slide, but the primary reason for the outperformance was the fund's overweight to high-yield bonds, along with issue selection by the fund's Core Plus manager, PIMCO. Detractor to the fund's performance include the fund's allocation to global bonds was negatively impacted by the appreciation of the US dollar. The fund's allocation to investment-grade credit also detracted as we saw spreads tightened.
All right, so moving on to our final fund, the Inflation Protection Fund. It looks like this fund significantly outperformed its benchmark for the quarter.
The Inflation Protection Fund has really showcased its purpose, not only last year, but also this year, since inflation is an ongoing concern and could be for some time. As a reminder, this fund was created to protect investment portfolios against unanticipated inflation while providing that stream of income. It ended the quarter outperforming its benchmark by 1.55 percentage points. And the primary reason for the outperformance is its allocation to floating rate loans, as well as the fund's allocation and asset manager selection in emerging market inflation-linked bonds. Also, relative to the fund's custom benchmark, the fund is underweight UK inflation-linked bonds, or UK linkers, which contributed to the fund performance. As I conclude my portion of the webinar, I wanted to inform our viewers that we continue to actively engage our external asset managers daily regarding the markets and also their portfolios. We continue to have conviction in the fund's diversifying allocations and have not made any major adjustments or shifts to the underlying fund allocations. We have confidence in the managers that we have selected and hired to manage the assets on behalf of all of our investors. Our best interest is our clients' best interest, and we are here to work with our clients to ensure that we are continuing to invest on their behalf in a way that allows them to meet their long-term financial goals and support the mission of their organization.
Thanks for the performance update, Karen. Thanks for sitting down with me today, Dave, to provide what is sure to be a packed economic update.
Happy to be here, Joe.
So, Dave, we should probably start out with the state of the markets. As I showed earlier in the webinar, together the bond and stock markets have erased about a fifth of the value of the average diversified investment portfolio. How much longer are investors going to see erosion in the value of their hard-earned savings?
Yeah, I wish I could provide you with a definitive answer, Joe, but I can't. As you stated earlier, the current bear market is particularly insidious because it's affected both the stock and the bond markets. Every bear market is unique, and no one can really predict when it's going to end. This chart looks at bear markets a bit differently compared to the slide that you showed earlier, Joe. We define a bear market as when stocks represented by the popular S&P 500 index have declined by more than 20%. Now, over the past 60 years, we've started and ended 8 bear markets. We are currently experiencing the 9th. The 9th could have ended earlier this week, but we won't know until we've reached the prior market high set on the first trading day of this year. As you can see on the chart, Joe, the length and magnitude of every bear market is different. The longest one we've had in the last 60 years occurred with the bursting of the tech bubble. The market lost nearly half of its value. That bear market lasted 2.5 years. We had a bear market with similar losses with the bursting of the housing bubble. That bear market lasted 1.5 years. The most recent bear market prior to today's was the 1 month at the onset of the pandemic when stocks lost 1/3 of their value. I should emphasize that the decline we saw for that 1 month was quite a bit more than the stock losses we've experienced so far this year.
So then, Dave, do you see any parallels between what we're experiencing today and any of the 8 past bear markets that you showed on your earlier slide?
So I guess, Joe, that I can see some parallels with several of the past bear markets. So in 1973 and 74, we had an inflation shock caused by the OPEC oil embargo. We had an even more severe inflation shock in the early 80s with the 2 straight years of double-digit inflation. Then in 1987, we had a spike in interest rates, though rates back then were much higher than what we've seen over the last year. The bear market at the turn of the 21st century is largely attributable to excessive valuations in the tech sector. Then coming out of the pandemic, we had similar frothy valuations among a variety of stocks linked to the pandemic lockdowns. The 2007 to early 2009 bear market resulted from the Great Financial Crisis, or GFC, and is largely attributable to that overheated housing market. As we know, the housing market has been on fire since the start of the pandemic, though what led to the GFC were aggressive lending practices. Banks are much more circumspect today when originating loans. But to state the obvious, Joe, it is inflation and the Federal Reserve's resolve to control inflation that is contributing to the current angst in both the stock and bond markets.
So Dave, let's dig into that a little bit more. The Federal Reserve continues to message its resolute position that it will aggressively raise the overnight borrowing rate until inflation has receded. I spoke earlier about how the market expects another 1.5% increase in rates, which will take the Fed funds rate to a range of 4.5 to 4.75%. Do you think that this last 1.5% increase will get the job done, and are we finally going to see inflation ebb?
So I wish I could predict what's going to happen with inflation, Joe, and whether the Fed is finally going to get the job done. There are some positive signs that inflation may be receding, but the Fed wants inflation to average 2%. And while I feel reasonably confident that current levels of inflation in the 8% range are unlikely to persist, I'm not at all confident that we're going to get to 2% anytime soon, absent a severe recession.
So let's unpack that a bit, Dave. I have several follow-up questions regarding what you just said. What makes you confident that we can look at inflation rates at 8 and 9% and put them in the rearview mirror?
Well, Joe, let's start by reminding our viewers about the major contributors to U.S. inflation. Housing, food, and transportation account for 3/4 of inflation. Now, this next slide looks at the spikes we've seen in 2 of those categories. The chart on the left looks at 40 years of food inflation. We've seen a huge spike with food inflation currently running at nearly 11%. And in fact, food at home inflation is up 13%.
So Dave, what's causing the spike in food prices?
I think it's been a confluence of events, Joe. The pandemic caused a massive shift in the food supply chain. We've had a worker shortage that's resulted in higher prices for harvesting, processing, and transporting food. Russia's war hasn't helped, causing a spike in fertilizer prices and a shortage of wheat. It will take a bit of time to adapt, but I do expect for food price increases to come down in the near term, and I don't think we'll continue to see food price increases anywhere near what we've experienced recently. Now, the chart on the right looks at transportation prices. This category is one of the most volatile, tracked by the Bureau of Economic Analysis. Higher gas prices have certainly impacted transportation inflation. We've also had a big bounce back in airfares after they cratered during the first months of the pandemic. Huge demand for new and used cars have also had an impact. Here too, I have less concerns about persistent elevated levels of inflation. We should see a meaningful drop in transportation inflation over the next several months.
So what about shelter? And what are your thoughts about inflation for the largest component of CPI?
Yeah, so that's where I'm a bit concerned about the increases that we've seen in housing. And I'm worried that absent, again, a major recession, that we're likely to continue to see elevated levels in the cost of housing. We've seen massive increases in housing prices since the pandemic. When combined with mortgage rates at generational highs, housing is now less affordable than it's been in a long time. On this slide, we see that inflation for shelter has risen above 6% for the first time since the early 80s. The chart on the right shows a spike for one of the components of shelter inflation, and that's rent inflation. Again, the highest rate increase in 40 years. And I have one last chart on housing that looks at a CPI category tracked by the BEA called Owner's Equivalent Rent. This is a measure of how much money property owners would have to pay in rent to equal the cost of ownership. When the BEA released its monthly inflation report last week, it reported that the inflation for owning a home increased the most since it started tracking this category 40 years ago. If housing prices and mortgage rates remain elevated, I'm afraid that shelter inflation is unlikely to decline anytime soon. This next chart provides additional data on the state of the U.S. housing market. The chart on the left is data from the National Association of Realtors, which takes a different look at the economics of home ownership. The Housing Affordability Index measures at what a typical family earns and the extent to which they can qualify for a mortgage loan on a typical home at the national and regional levels based upon the most recent price and income data. The information in this chart reflects data through the end of July, and I fully expect that once we see the September data, that housing affordability will again be the lowest in nearly 40 years. The two charts on the right reinforces the notion that housing inflation could remain elevated for some time. The top chart shows that housing inventory levels remain near the lowest level in 40 years. And the chart in the bottom shows that apartment vacancy levels remain well below their long-term averages. So again, Joe, absent a meaningful recession, I'm afraid we're likely to see mid-single-digit inflation levels for a segment that makes up 42% of the CPI. And a return to 2% inflation could be a few years out.
So Dave, you just said absent a meaningful recession. Part of the current market narrative is that the Fed will overshoot its efforts to tamp down inflation. What are your current thoughts on the likelihood that we will see a meaningful recession?
So as you know, Joe, the economy contracted in each of the first 2 quarters of the year for a combined 1.5% decline in gross domestic product. But as viewers of our last webinar may recall, 2 consecutive quarters of contraction does not necessarily define a recession. The official arbiter of whether we've entered a recession looks at numerous factors, including employment conditions, personal income, and a few other data points. Employment remains strong. The September unemployment rate was 3.5%, and that's running near 50-year lows. Levels of inflation-adjusted personal income remains steady in 2022 after declines from 2020 and 2021, resulting from a discontinuation of the government stimulus checks. On this slide, we see that the Atlanta Federal Reserve is forecasting 2.8% growth in the third quarter. On the right, we see results from the most recent Wall Street Journal survey of economists. While these numbers aren't all that exciting, so far at least, the consensus isn't calling for a recession in the next 2 years. Now, last week, the International Monetary Fund, or IMF, released its economic forecast for the U.S. and the rest of the world. For this year, for world growth, they're forecasting that it will slow from 6% in 2021 to 3.2% this year, and then next year at 2.7%. And for the United States, the IMF said that our economy will grow at 1.6% this year, but then just 1% in 2023. And while there are those that might lament when they hear that the U.S. economy may grow by less than 2% for 2 consecutive years, I'm not as concerned as others might be. I mean, the reality is that we've seen major disruptions over the last 3 years, starting with the pandemic. So much of how we live our lives have changed. We've had to adapt. We've experienced pain, and we'll experience more pain as we learn to adapt to the current challenges. But as you know, Joe, we believe in human resilience. Remember those 8 bear markets I highlighted earlier? In each of those, we faced significant and unique challenges, yet our economy recovered and markets posted new highs. And I have no reason to believe that this time is different.
Thanks, Dave. I agree. This is a unique bear market and another wall of worry. Also, for each of those 8 periods causing bear markets, there were many that thought that the world had changed and not for the better, but we navigated through the challenges and ended up in a better place than we were before. So let's transition to another topic, and that's the strong US dollar. When was the last time the dollar rose as much as it has in 2022?
Well, Joe, it's been quite a long time. This chart looks at 37 years of history for the US dollar index. 2022 represents the single biggest gain for the dollar over the past 37 years.
So Dave, an overly strong dollar can be problematic for a US investor holding foreign currency as the currency goes down in value. Also, since oil and commodities are priced in dollars, a strong dollar makes food and energy very expensive for foreign countries. So Dave, what's causing the dollar to spike relative to foreign currencies?
So there are a variety of reasons, Joe. First, the 3 most common foreign currencies compared against the dollar are the euro, the British pound, and the Japanese yen. All 3 of these currencies have materially depreciated against the dollar and for different reasons. So let's start with the pound. We've seen multiple shocks in Britain this year. I've read several stories about what's going on in the British economy, and all basically say the economy's in a shamble. The change in leadership hasn't helped, and the death of the Queen has certainly had a negative psychological impact. But the main factors seem to be high inflation, high housing prices, multiple paralyzing strikes, declining productivity, and poor business confidence. The euro has suffered from the effects of the Russian war and its impact on energy and food. Japan has seen higher inflation, though not nearly as high as we've seen in the US. But its central bank has been insistent on keeping interest rates low. Combine all of this with an aggressive Federal Reserve and US interest rates that are higher than most, but not all, of the developed world, and the result has been unprecedented US dollar strength.
So Dave, how long do you think that we're going to continue to see this current dollar strength?
Yeah, Joe, it's hard to say. Conditions in the UK and Europe don't appear to be improving anytime soon. Many are worried about the upcoming winter and the extent to which the current European energy crisis will adversely affect consumer psyches. A strong dollar is a plus as foreign goods are cheaper, which is going to have a positive impact on our inflation. But the offset is that US goods are more expensive to foreign buyers, which adversely affects corporate profitability and ultimately US jobs. The US has issued an awful lot of debt over the past few years. Foreigners own a meaningful amount of US government bonds. Accordingly, one must be cautious in predicting continued dollar strength.
Okay, thanks, Dave. So let's wrap up by returning to where we started, the state of the US stock market. What can you tell our viewers about stock market valuations?
Well, Joe, as one might expect, with declines as much as 30% for the US and world markets, stocks look a lot cheaper. Corporate earnings have held up reasonably well, and analysts expect mid to high single-digit earnings growth in 2023, although estimate forecasts will certainly change if the economy enters a recession. Let's start by looking at US stock valuations. The left chart in the slide looks at the price to earnings ratio for the 50 largest mega cap US stocks based on analyst forecasts for the next 12 months' earnings. These are your Apples, Amazon, Microsofts, and Googles. And while the PE ratio has come down a lot, it remains above the 20-year average. Hence, one might reasonably expect further declines in the big, large company tech stocks. But take a look at the chart on the right, Joe. The PE ratio for a universe of small company stocks is approaching the lows reached 2 other times over the past 20 plus years. And while prices for these small companies could continue to fall, they certainly appear cheap using the PE metric. The same is true for international stocks. Now, the last slide for my portion of the webinar looks at valuations for developed international stocks on the left and emerging market stocks on the right. Both appear attractive relative to their long-term averages. Now, I also looked at dividend rates for both the developed and emerging market stock markets. Both markets yield more than 3%, with emerging market stocks yielding 3.5%. And again, while I'm not predicting that we've reached bottom, I can take comfort in knowing that international stocks look reasonably cheap. So it's been a tough first 9 months to the year, Joe. But as I showed earlier, bear markets are not rare events. The US and world face many challenges, but we maintain our steadfast belief in human resilience. I do believe that our patience will be rewarded.
Well, thanks for your thoughts, Dave. It's a great discussion in a complex and changing economic landscape. I'm joined now by my colleague Jake Barnett to provide our Sustainable Investment Stewardship update. We've been seeing a lot more news about ESG in the headlines recently, with prominent anti-ESG critics and skeptics coming to the forefront. So Jake, I'd like you to focus your update this quarter on that subject. Can you tell us a little bit more about why these criticisms are happening?
Sure, Joe. Happy to speak on this. As you said, lately there has been a rise in criticism and skepticism about ESG, or environmental, social, and governance investing. ESG has been around for many years now, first gaining prominence in 2005 with the formation of the Principles of Responsible Investment, of which Wespath was a founding signatory. However, the growth in interest and investment flows into ESG strategies has sharply increased, especially over the last 5 years. This has been driven by a number of factors, including increasing investor recognition of the financial risks associated with environmental and social issues. Those issues include topics like climate change and diversity, equity, and inclusion. And that focus is paired with an increasing recognition that you do not necessarily have to give up investment performance to invest in ESG funds. I think a lot of the pushback on ESG is actually a signal of it becoming a victim of its own success. As this trend gained prominence, there's sometimes been grandiose promises made by ESG practitioners about the ability of ESG to solve a wide range of complex problems. These claims are now increasingly being questioned. Additionally, ESG has become somewhat of a political hockey puck, this year especially, with both sides of the aisle finding reasons to either criticize or laud the investment practice. All of this has led to much more robust dialogue in the public squares about the merits and pitfalls of ESG, more so than anything we've experienced before.
So Jake, what are some of the key criticisms from detractors, and how would Wespath respond to these criticisms?
So Joe, there's a whole wide range of criticisms depending on the perspective and motivation of the individual making the criticism. But there are 4 key narratives we see from those questioning ESG, and we'll show those on the following slide. The first 2 are long-standing criticisms that have been around since ESG was first introduced into the investment ecosystem. So the first one you see is that consideration of anything other than financial factors will lead to lower returns. The second is that ESG is nothing more than a marketing exercise and way for asset managers and consultants to charge more fees. The third criticism that has emerged more prominently in recent dialogue effectively follows a line that this is an overtly liberal and partisan exploitation of the tools of finance by investors to further political goals. The last criticism often comes from individuals who may believe in the goals purported by ESG, but do not think that investment is the proper means to achieve those goals. On this next slide, you see our perspective and responses to some of those criticisms. The first 2 are relatively straightforward. As a long-term investor who has over a decade of experience using ESG as part of our investment process, we look at the use of ESG holistically, and as part of a good, robust investment process. As such, it has not been our experience that it leads to lower investment returns. Secondly, as an institutional investor, we recognize that some fund managers may try to charge higher fees for ESG strategies. But we categorically do not pay more simply for ESG integration. We think this should be integrated as part of an asset manager's approach and not an add-on that they charge more for. On the third point, it is important to note that we analyze investment and engagement decisions through the lens of our sustainable economy framework. As a quick reminder, this framework states that investors need to support the transition to a sustainable global economy in order to achieve the returns that support their financial goals. We recognize that such a transition is a complex proposition, and no one corner of society has all the answers of what that should look like. As such, we try to be holistic, curious, and open-minded in taking in any information that will support us better understanding the risks, regardless of the source. Finally, on the last point, we engage in deep due diligence with our asset managers, including an annual questionnaire and focused engagement follow-ups that help us understand the underlying actions that managers are taking beyond their high-level stated activity. This helps us understand the core investment process of the managers and their alignment with our sustainable economy framework.
It's all great information, Jake. How can people continue to learn what we're doing on this topic?
Our CIO, Dave Zellner, wrote an excellent op-ed on this topic that you can find on our website. I would encourage everyone to start there in terms of their reading. Additionally, we will continue to publish blog posts and other social media talking through our perspective. So if you're not following us on social media already, please do so.
Great, Jake, thanks for your time and for that wonderful update.
Thanks, Joe.
Thank you for joining us for the third quarter Wespath webinar. If you have any questions, please email us at investmentinfo@wespath.org or visit our website. We look forward to seeing you next quarter.